like to thank everybody for coming tonight. We hope that tonight's more of a discussion with all of you guys. We appreciate you sharing your time with us. Joining me to my left and your right, at the far end is Raj Chatterjee. Raj has about 17 years experience in the industry and has been with our firm since 2017. Next to Raj is Dan McGinnis. Dan has about 14 years experience. He's been with our firm since 2018. And then to my immediate left is Nick, who has just over 20 years experience. He's been with us since 2009. So between us, we should be able to answer just about anything you guys come up with tonight with the questions. You know, we started Carver Financial in 1990, and I've been in the business since 1986. And certainly a lot of things have changed as far as the types of investments and the economy and so forth. But as much as things change, there are a lot of things that remain the same. And that's some of what we're going to chat about this evening. Three kind of quick thoughts on that. The first is there's certain things that we know and certain things we don't know. We know what the current tax laws are. We know what the regulations are. We can control to some extent expenses and allocation. We don't know what markets are going to do. You know, over the long term, we know they're going to go up, but day to day, month to month, even year to year, we just don't know. And frankly, it doesn't matter with proper planning. The second thing is people like to ask what's going to happen, and that's a great question. But the more important question is not what's going to happen, but how is what's going to happen going to affect you? And if the answer is not because of the planning, that becomes more of an academic discussion. The last thing to keep in mind is there's always been kind of an X factor, and that's technology. You know, if we look back over the years, there have been certain paradigm shifts going back 200 years. You know, at the turn of the century when the steam engine came out, it really changed everything in this country. If you think back to microchips and personal computers, which has brought about everything from cell phones to where we're at today. And then you think about the internet. Every one of you was around before the internet existed. I mean, think about that. There was no social media. There was no email. I mean, what did people do all day? You couldn't access information. I mean, none of that existed just 28 years ago. The shift we're seeing now is something called generative AI. Artificial intelligence has been around since the 1950s. They used to call it machine learning. But what's happening now is the information is generative. In other words, it actually learns on its own. And that is really starting to change what's happening. And again, we'd suggest that's another one of these paradigm shifts. They're very, very positive. Every one of these things people were afraid of when they happened, and they've all created efficiencies and helped things. So as we look ahead, you know, again, there are things we know and there's things we don't know. But we're going to try to address any and all questions that you guys have tonight, and we're going to ask you some questions. So on your tables, there's a QR code, or you can point your phone at this, open up your camera app, and if you point it, don't take a picture. If you point the camera app either at this guy or the one on your table, you'll be able to open up our polling and be able to answer some questions. If you need help, just kind of put up your hand and we'll come help you. Should be fairly easy to do this. So I'll give you a second to try. When it opens, it's going to say Q&A, and then on the other side, it's going to say polls. If you just click on the polls, it should be all set. So again, we'll give you a second. If anyone has a issue, we'll get someone to help you. Just put up your hand. You got it? Like I said, if you have a problem, just put up your hand and Paige or Kale, one of us, need help. Can you help her real quick? Give you a help. So as we look at this coming year, there are three things I think are going to be a focus. Obviously, people are going to talk about the election, and we'll touch on that a little bit. Talk about tax policy and some changes, which we're going to chat about, and then just the overall economy. Anytime there's uncertainty, that's what makes markets go up and down. So I'll ask you guys, and you can take the poll on your phones, how often do you think the stock market, so over the last 50, 60 years, how often does it drop 10% or more? About every 6 months, about every 8 months, about every 2 years, or about every 3 years? So here we go. So you guys are picking. So 2 years is by far the most. Still changing. And think about it. The Dow Jones is at 32,000. A 10% drop would be 3,000 points. If the market dropped 3,000 points tomorrow, the media would lose their minds. So the majority of you think about every 2 years drops 10% or more. The reality is about every 8 months or less, you get that drop. In fact, every 2 months, you get a 5% dip or more, which is 1,500 points. So when you turn on the TV or you look at the internet, say the market dropped 300 points, it's really nothing because the market's so high. So these types of swings are pretty normal. And we can expect and should expect them. And there's nothing to really be too concerned about. Now, there are three big news stories, it seems, that occur over and over and over. Right now, a lot of people are concerned about the deficit. See the black hole, and some other Time magazine covers is there light at the end of the tunnel, and then a wild week on Wall Street. So talk about the deficit and the markets is always something people speak about. There's always a pandemic. The latest one being COVID. Prior to that was bird flu. But if you go back to the turn of the century, you had polio, we had Ebola, we had AIDS. That there's always something coming. And then lastly, war in the Middle East and Israel. You know, right now they're talking about Gaza and so forth. So I'll ask you guys a question. With these covers, when do you think they were? This year? The last couple of years? 2010 to 2023? Back in the 90s? Back in the 70s? Or in the 80s? What do you think? Oh, nobody has an answer. Oh, there we go. Nice. So you guys are getting good at this. So, you're absolutely right. This is 1970, 74, 1982. The deficit black hole was 1984. It's after Reagan got elected. They were talking about the giant deficit from what they were spending. So we see these things over and over and over. And again, as much as they'd have you believe this time it's different, it really isn't. It's something we've seen. Now, the other question we get a lot, It's about the election. Elections don't have as much impact as you might think on the markets. And we'll talk about that in a second, a little bit more. But typically, in presidential election years, the market's made slightly less than non-election years. On average, about 11%. But some years are good, some years are bad. What's interesting is, if you look at the mix, the best combination has always been a split between the president and the Congress. So the best combination going all the way back to 1950 has been a Democratic president with a Republican Congress. And on average, the S&P's made about 18.5%. The second best combination is a Republican president with a split Congress, which is kind of interesting because it couldn't be much more split than it is today. And then the third best is again a Democrat in the White House and a split Congress. But it's a little counterintuitive. But typically having some of that check and balance debate has been better than having one party control everything. So certainly as we get into this next year, there'll be a lot of hand-wringing about if this person wins or that person wins. I wouldn't read too much into that, as far as that goes. So, one thing we do know, talking about what's coming, is that in 2025, some of the tax cuts that were put in place are going to expire. Now, in theory, Congress could vote to extend these, although we think it's fairly unlikely. But this is important to note because number one, income taxes will go up, but the estate credit's going to drop dramatically. So right now, if your estate is under $12.9 million, or for a married couple, about $25 million, there's no federal estate tax. At the end of 2025, that number is going to drop to about 5.5 million. Still a lot of money, but it's a pretty dramatic dip. Along with this, things like the phase out of itemized deduction will start again. How many of you remember alternative minimum tax? Yeah, that's going to come back, et cetera. So at this point, we do know they'll sunset. We don't know what they'll vote for. But this is something you may start to hear more and more about. The other thing that's changed a lot is with retirement from the Secure Act and also with Social Security, something people are talking about. So now I want to switch gears a little bit. I want to talk a little bit about the future of Social Security, inflation, and sources of retirement income. So we got another question for you guys before Nick kind of jumps on some of this. And before I do this, do we have any questions for the panel at all at this point? Okay. So how many times do you guys think Social Security's been reformed since it was created? And I do have the two questions you guys have texted in. The interest rate question, Raj is going to get to in a few minutes. And when we get to the end, I'll kind of address the war question about my daughter. So the consensus seems to be Social Security's been reformed about 10 times. So what do you think, Nick?
I think everybody's pretty right. So what we generally do when we get this question is it's going to be in the media, and we have a saying, I think it's the media's job to make every problem your problem. So if you watch the news these days, there's so many problems going on. Social Security changes certainly are going to happen, and it's going to impact people in different ways. But I think it helps to look back over time and just kind of revisit When was Social Security started? 1935 is when it was actually started. Taxes were starting to be collected in 1937. Actual monthly benefits started in 1940, right? There's one question not up here though. The full retirement age is leading up to about age 67 now, but it used to be 65 years of age. Does anyone in the crowd know what decade they actually lowered the full retirement age to 62? Anybody have a guess? What decade? 1956. They actually gave women the right to turn on their benefits earlier at age 62. Men didn't get the ability to do it until 1961, okay? So this is one of those changes that were kind of pivotal years ago. But we're basically at the point where the article headlines you're gonna see is saying Social Security is gonna run out of money and everybody's gonna get less. Yes, if true, if no reforms are made. But there was one critical reform back in 1983. A lot of those slides that Randy was going through, there was a lot going on, obviously, just like today. But Reagan was in office and they passed the reform to essentially start taxing Social Security benefits. So anybody that's receiving them understands how the means test works. If you make a certain amount of income, including some of those benefits, they start including some of those Social Security as taxable income. The other thing they did during that time is they started taxing the higher percentage of the money that we earn through payroll. So think back 20 years ago, now Clinton's in office, and they actually did away with the income cap for anything over a certain threshold in the year you turned full retirement. So at that point, it was still 65. The point I'm making is it's a simple problem that needs to be solved, and it's a problem that's actually reared its head multiple times historically. And the solutions to the problem are pretty straightforward, is increase the amount of taxes that they bring in to Social Security, or reduce the benefits that are paid out. So there's a couple other things up here. Privatization of Social Security was actually part of the 1983 reform too, and that's when 401ks were born, right? Prior to that, most companies offered pension plans. You worked for 40, 50 years. They gave you a benefit for the rest of your life. This was their way of saying, okay, instead of giving money to corporations or the government, they privatized it. Most of the reform legislation that's circulating in Congress now has a couple different ages in place. So 55 plus years of age, they're saying you probably won't see any major differences in your projected benefits. There was a recent, some legislation rolling around from the Republican Party that actually would say if you're 62 years or older, then you wouldn't see any changes. So part of the reason we wanted to bring this question up is all of what we're doing today is thinking a couple years ahead and trying to acknowledge that there's going to be some big issues on the horizon, and separate what the media is going to be talking about and then the reality of what ultimately ends up happening, right? Now, if anyone in the room knows somebody that's 35 years of age, I would say under the age of 50, there's probably going to be some pretty big changes happening to their benefits when they become eligible for Social Security. So one of the things that's probably going to happen, they're going to keep bumping up the full retirement age from 67 to say age 70 before you can get full benefits. So someone in my category may have to wait longer to get a higher payout, but I could still probably turn it on at 62 if I decided to take a reduced benefit. If I want to counter that loss potentially, or that reduction in benefit, one, I could live a heck of a lot longer than they bet I is going to live. But the other thing is you can start putting away more money now, right? So if you walk out of here tonight, if you have someone you love in your family that is planning on at some point 10 years, 15 years from now banking on Social Security, it might be worth having that conversation of there could be a possible reduction or a delay of their retirement to get that higher benefit. So any questions on that though? Yeah.
I'm going to guess the answer is no, but I was told that they basically, the government has robbed the Social Security system to pay for their special projects. Would there be any possible way they would quit robbing Social Security so that you wouldn't have to implement?
Yeah, so that's a really good question because we look at Social Security as like a political football, right? Whoever's not in office uses it against the other party, and that's been going on for decades. If you actually look back over the history, it was part of Franklin Delano Roosevelt's second New Deal, right? The first New Deal was the banking system during the Depression. The second deal was Social Security. Part of the money raised for that program, though, was actually spent during wartime efforts later that decade, too. So the robbing or using of funds, it's been going on for a real long time, right? There actually was a point back in the late 90s, when we were talking about the deficit a second ago. If anybody recalls, we actually had a surplus for about a year and a half until the Middle East conflicts started up in Afghanistan, Iraq, and stuff. The point I'm making is the government has the ability to shift funds around. And if you think about the retiree public today, 97% of retirees get Social Security. So imagine what the capital would look like if you start taking away benefits from current recipients, right? So the solution that we think is a combination between delaying benefits and increasing taxes on those that are working.
That benefit is also, there's actuarial formulas that will project what that balance is and how long it's projected to pay out. So if anyone here has had a pension and the option to take a lump sum pension payment, right, versus, a monthly, that lump sum payment is based off of current interest rates. So the lower the interest rate is, to fund that obligation, you need a larger sum of money because it's a lower interest rate. That's the risk-free rate. So as rates increase, the amount that's needed in the total fund is essentially less because you can earn more on those dollars, right? So for 15 years, and we'll talk about it more, we've been in a historically low interest rate environment. So the amount that's needed, thus what's obligated to be paid out, shows that you're at far more of a deficit than what you are in a normalized environment. So there's multiple parts to it, but I wouldn't be overly concerned that the money won't be there, when you need it.
Yep. This is a general question. Is Social Security in a general fund? In other words, it's not a fund in its entity, but it is a part of the general fund, which means they can rob and take.
Yeah, there's a trust fund, right? So they did designate tax dollars to go into a pool called the trust fund to then pay out those future obligations. When they created this, though, is you think about life expectancy. In 1935, the life expectancy was probably early 60s. Life expectancy for a woman today is 87, men are 85. We have tons of couples that live well beyond, those ages too. So people have been living longer, right? And as time has gone on and that life expectancy's changed, that's when the reforms have happened. So prior to 1983, we were in the exact same situation. They had used the money for other purposes. There wasn't enough money in the trust fund, and then they started modifying, the payouts, the taxes, all kinds of stuff.
And it's not a pool of money. Social Security is a tax. So it's not like there's a pool of money for the military. The government taxes and then distributes the money as needed. So when they tax for Social Security, ostensibly it goes into the Social Security fund, but it can be used for anything. It's not as if your money's there and you get back your money. It's just another tax. Maybe it's an easier way to look at it.
That's part of the reform to then, say, okay, any of those dollars do go into that trust and can never be used for anything else. That would be like privatization, right? Maybe you have your own Social Security account, you do whatever you want with it, right?
So here's another question for you guys. So at what age do you have to start drawing on a traditional IRA? What age is the required minimum distribution required? And this has changed, so I'll give you a little hint. It has changed a couple times. Oh, neck and neck. That's a good question, too. Okay. So we got 10% say 76, 23% say age 70, and about 68% say age 60, or say 73. So Dan, what's the answer?
Well, nice job. It's changed a little bit over the past couple of years. So it was 70 and a half until the end of 2019 when the original Secure Act was passed. They increased the age to 72, and then effective this year, the new age is 73. And required minimum distributions, which we refer to as RMDs, they apply to any retirement plan, 401k, 403b, 457, and traditional IRAs, and actually, believe it or not, Roth 401ks as well. The benefit of Roth money is when that money comes out, including earnings, as long as it's qualified, it's all tax-free, including all the money you've made. Now, I will say anyone who is under the age of 73 in 2032, so roughly 10 years down the road, the age is 75. So for the younger folks in the room, the RMD age is going to be 75. And that was part of Secure Act 2.0. So the big legislative change back in the original Secure Act was the rule on inherited IRAs and Roth IRAs. So a lot of you may be familiar with what we call the 10-year rule. So if you were a non-spouse and you inherited a retirement account from a family member, friend, whoever it may be, the old rule was you could base, as long as that decedent was taking required minimum distributions prior to passing away, you would have to assume those based on your life expectancy, and you'd have to take out an annual amount every year, for your lifetime. What they did is they accelerated that rule to try and raise more revenue, more tax revenue, over a 10-year period. And originally what they said is you didn't have to take that minimum annual amount, but it all had to come out at the end of that 10th year. And there's been a lot of debate in Washington as to whether or not they should reinstitute that annual amount, because I think a lot of people have been deferring. So what that's done from a planning perspective for us and clients is a lot of clients are thinking about ways to either accelerate distributions to get more money to a tax-free bucket like a Roth IRA, if they're concerned about kids inheriting money that may be in a higher tax bracket and have to take that out over a 10-year period. Because if you think about $1 million IRA, over 10 years, it's $100,000 a year that has to come out if you did it equally, and that's assuming no growth on the money. So it has presented a lot of, or I guess it's really made a lot of folks think about strategies over that 10-year period. They've done a couple other things too. So required minimum distributions, they are mandatory. If you don't take them out, the IRS will assess a penalty, 50%, which they're reducing, which is part of Secure Act 2.0. There are some other ways. One thing you may be familiar with is a qualified charitable distribution, which is if you take that money, now that money has to be in a traditional IRA. QCDs is what we refer to them as. You cannot do them from 401ks or 403bs. They've got to be rolled, or like a Ohio Deferred Compensation. That's got to be rolled to an IRA, and the qualified charitable distribution gets processed from there. But what that is if you want to give to your church, alma mater, any 501c3 nonprofit organization, that distribution does count towards your RMD, and it's excluded from taxable income. So that's one thing people do to use some of that money towards that and save on some tax. The other thing that you can do is you can just take the RMD money and withhold tax and then move it to a brokerage account and invest, in your after-tax account. So those are some other options if you don't need the money. Secure Act 2.0, the one nice thing and this is in employer-sponsored plans, not IRAs. So think about 401ks. Employer matching money has always been pre-tax. They've now allowed, it's really getting rolled out. It's been kind of slow to get rolled out. But if you are participating in a 401k plan and you're interested in adding more Roth money, you should look into employer match being Roth as well. So that's one new rule that they've implemented. which is kind of neat. And again, the benefit of Roth is not today, it's down the road. When you go to take distributions, all that money, including growth, is tax-free. And there won't be RMDs on Roth money in the future. Another interesting planning opportunity is we get a lot of questions about 529s from grandparents and parents for their children and grandchildren. A common question is, what if I'm adding money to this and then down the road the kids don't use it for qualified education expenses? One of the new rules is after a 529's been in place for 15 years, if it's not used for education, that could be rolled to a Roth IRA for the beneficiary, for the grandchild or the child. So that's a nice plan, and that's going to get rolled out next year. There are some limits, lifetime limit of $35,000, and it's subject to the annual IRA contribution limit, which for people under the age of 50 right now is $6,500, $7,500 for people 50 and up. Next year, they're increasing that by $500. Those numbers just came out recently. So for IRAs and Roths next year, you can put $7,000 or $8,000 if you're 50 and up. And then one other area of the marketplace, or I should say the economy, most of the businesses in this country are small businesses. They really run the economy. And there's a lot of small businesses that still don't offer employer-sponsored retirement plans for their employees. So another thing that this Secure 2.0 has done is it's offering a lot of tax credits for companies to start up retirement plans, whether it's 401ks, simple IRAs, stuff like that. So the thought behind that is to really offset the startup costs for the business and provide those tax credits to incentivize. Really, because to Nick's point, the pension plans aren't going to carry us. Social Security is not really going to cut it. So it's really on the saver, and it's on the employer, and it's on advisors to educate the population on the importance of financial planning.
One of you guys just asked, actually these are good questions, and we'll get to all of them. Does the employer contribution as a Roth count against the allowable contribution? The answer is no. They're independent. The Roth you do on your own is totally independent of what the employer match would be. The other interesting one is starting next year, one of the problems is people have student loans, and so they may not put into the 401k. And the government knows we have a savings problem in this country. So what they're going to allow is if somebody pays their student loans, the employer can match that into the 401k. So you don't have to put in the 401k to get a match. And that the details of that will be coming out next year. So if you know of somebody with student loans, that may be something to look into. One other question, any update on the long-term care tax for income in Ohio? No. Ohio, there are a number of states, I know we talked about this at another event, Oregon and Washington and California have now passed an income tax if you don't have a long-term care policy. Ohio currently doesn't have anything pending. Pennsylvania does, and about 14 other states do. But at this point, there's nothing specifically pending in Ohio. But the idea would be, if you don't have a long-term care policy, then the state would tax your income probably 0.5% a year. So it's not horrible, but it's states looking ostensibly to prop up Medicaid. But the reality is it's just kind of a money grab in our opinion, as far as that goes. Another question which leads into our next kind of thing, do you foresee interest rates rising or falling in the next few years? So Raj is going to talk about interest rates in just a minute. And obviously one of the things that impacts interest rates, or at least that we hear about, is the Fed funds rate and the Federal Reserve. A lot of talk this week. Is the Fed going to raise rates? Is the Fed not going to raise rates? So the question for you guys, is the Federal Reserve Bank a part of the government? 100% yes. Ooh, that was a quick change. So we went from 100% yes to 83% no. That's a quick reversal. So 87% say no, 16% say yes. So Raj, what's the answer?
Technically, no, it's not.
Yeah, you guys are smart.
But this is, there's a lot of debate and, who owns the Fed, who operates the Fed, things like that. So the Fed is a private entity. It's not one of the branches of the government. It's not governed by the branches of government, but its directors, its presidents, at the 12 Federal Reserve banks, it's all appointed through Congress, right? So, the Fed itself is owned by the member banks. There's a lot of debate out there that, there's certain families that established it, but the Fed operates as the U.S.'s central bank. Prior to the Fed being established in 1913, there were 4 other, call it versions of a central bank. The reason you hear a lot that certain people or these families are the owners and that's who the money is. If you think back to 1913, the member banks, there were some powerful families that probably had significant assets and control of a lot of these large banks. But over time, it's certainly expanded. And, quite frankly, today it plays a very prominent role in markets and the economy, maybe too much influence, some people could argue. The Fed has a couple main objectives. It's to control employment and then also control inflation. So they have a couple tools that they utilize. The most prominent one that we're all hearing about are interest rates, right? The discount rate. So what that means is every bank has certain capital reserves, ratios that they have to maintain. So if they have to meet that obligation each night, they may have to borrow money from another bank for overnight lending. So that's the baseline rate that everything is based off of. And from there, banks set rates on mortgages and auto loans and student loans and business loans. But that baseline rate is kind of the barometer that the whole economy goes off of. So this chart here illustrates, going back to 1950, what that baseline rate has been. And if you think of different economic scenarios or situations, when you go through a more difficult economic environment, for example, in 2008, when we went through the housing crisis, it affected the banks very severely. And what the Fed will do is they'll lower interest rates. They make money cheap. So if you think what that does, it stimulates the economy. It gets money flowing into the system. So if you want to go get a mortgage, if you're a business and you need to borrow money to, expand a product line or buy a competitor, you could borrow money at a low rate, invest it, and grow at that multiple. So as you see, in 2008, they lowered rates to virtually 0%. The range was 0 to 0.25. And low rates create a very accommodative environment for growth because you could take money, borrow at a low rate, invest it into something that it's likely going to attain a higher rate of return. So from 2008 to 2020, right before COVID, that baseline rate only went from 0 to 2.25. And as you can see, if you look through history, it's a very low rate, relatively speaking, okay? And we all have benefited from that. If you look at your 401ks, your investment portfolios, your homes, we all experienced a lot of growth over that period of time. So there's a great economist that we all follow, Brian Westbury. He refers to low interest rates as morphine. So you can't really feel some of the pain that might be happening or the cracks in the underlying economy because low rates kind of shield you from that. And we had many downturns in the market over that 12-year period, but things shot right back up because there was nowhere else to put your money. If you went to the bank and you wanted to, put it into a savings account, it's paying virtually 0%. CDs weren't paying anything. Treasuries were below 1% for a period of time. So, you only get to 2.25 when COVID hits. Then, we've never experienced anything like call it a global economic shutdown. So they slash rates right back down to 0. But at the same time, they injected $5 trillion into the economy, right? So it's a very accommodative environment, a lot of dollars chasing fewer goods, and that started to create bubbles or growth in certain sectors of the economy that were unsustainable. So what we experienced last year, going into 2020, we all expected rates to go up. The Fed went into the year saying that they expected the rate to go up a little over 1%. They raised rates from 0 to 4% in 1 year. So again, 12 years coming out of one of the worst economic environments, you only got to 2.25. In 1 year, they raised from 0 to 4%. Today, they're at 5.25. So that pace in which they raised rates, historically speaking, it's very aggressive, right? And so we all felt that in our portfolios. There was nowhere to hide last year. Stock market, S&P was down close to 20%. Bond funds were down 13%. Inflation was 8%, so a negative 8% return on your cash. It's tough, right? Everybody is feeling it. It doesn't feel good when you're going through this type of correction, but what they're doing is they're being very aggressive to try to tamp down inflation, and it's working. Last year, inflation was over 8%. Yesterday's print, it's at 3.7. If we read some of the headlines and the verbiage, they are now aware that these higher rates are starting to impact certain parts of the economy. So our view is, they're probably getting pretty close to plateauing. And then you may see rates stay at these levels for a period of time, but eventually they're going to start coming back down. And when that happens, the money will start to flow back into some of these risk assets, these growth-oriented assets. We saw a little bit of it at the beginning of the year. They anticipated rates to start coming down this year, and we got a bump in the market. Then more recently, they said, okay, it may stay higher for longer, and that's why we've sold off. But ultimately, we're going through a more prolonged market correction. If you look at it over normalized times, it usually does take a few years to really correct. I would say that the events of COVID, lowering rates right to 0, but then also the stimulus and the money that came in, it exasperated the expansion out of it, but it's probably exasperating the trough of an economic cycle as well. So I'll ask this question. Would you, as an investor, where you are in your life, would you prefer to have higher or lower interest rates?
You guys remember 12% CDs, 14% CDs. So you're kind of split. Hope it's changing. So about 3/4 of you would rather have lower rates. Okay. So my answer would be it depends what you're doing. Obviously if you're borrowing money, you want lower rates. If you're investing in bonds or stocks, you want lower rates. If you have cash, maybe you want higher rates. So show Raj's chart here.
Yeah, and look, everyone's different. For the last 15 years, it's been tough for retirees because that safer portion of your portfolio, you're getting very little return in the form of yield because interest rates were so low. That baseline rate was so low. So a lot of questions that we've been getting from clients is, hey, I can get 5% on a CD. It's safe. I don't have to deal with ups and downs of the market. Why don't we put, all of our money into there or move portions of the portfolio into there. And it's a valid point, right? So human nature, nobody likes the feeling of the downturn, right? We want all of the upside, none of the downside. The reality is you have to balance that. So this chart, it does a nice job because it illustrates on the far left where you see that diamond, that's the peak CD rate in each of these cycles that we're talking about. So the subsequent 12-month period after CD rates peak, other assets that you're invested in tend to do very well because right now they're undervalued. They're repricing back to a particular level based on raising rates, but everything from 6-month CDs, you have government bonds, corporate bonds, and then also the S&P 500. If rates are plateauing, it probably means a lot of these other areas of the portfolio are undervalued. They're on sale. So interest rates and the price of bonds, for example, they have an inverse relationship. So as rates go up, the price of bonds go down. So longer term treasury bonds, they were down over 40%, more than stocks were down in 2008. And people don't realize that, the bonds are usually the safer part of your portfolio, but for 15 years, we had very low, you can call it artificially low interest rates, and it pushed the price of these bonds to steep premiums. So if you had a bond that's getting 1% and now you could get 5%, you're gonna say, hey, I want my money because I wanna go invest it at 5%. It puts selling pressure on the price of those bonds. So for people in the room today, you can now buy into those bonds that have sold off and are trading at 80, 90 cents on the dollar. You're gonna get 3-4% in interest, and then also the upside appreciation as those bonds mature at their par value. So in these safer assets, you have some, call it 6% yield to worst. That's a technical term, but it's the total return that you can get on an investment that is much safer or less volatile than a stock, right? So it's creating a lot of opportunities. We have to get through that process.
Cool. So now, kind of bringing it around, you guys have heard us say it's not what you make that matters, it's what you keep after fees, expenses, and taxes. Let's talk about income tax for a minute. How many of you remember, going back to the 1960s, what the top tax rate was in the United States prior to John Kennedy reducing them? Any idea? It was 90%. So you paid 90% on your last dollars. Kennedy reduced them to 70%, and they stayed at 70% till 1982, when Ronald Reagan dropped it to 50%. So what do you think today is the average effective tax rate for most Americans? 10 to 15, 15 to 20, 20 to 25, or 25 to 30? It's your federal income tax rate. And it's not the rate, but effectively what you're paying as you write your check. Okay, so, still changing. Gotta lock it in. Final answer, lock it in. All right, so about 38% of you, 40% of you think it's 20 to 25%. 33% of you think it's 15 to 20. So Raj, what's the number?
13.63.
So the average person's paying 13.63% tax.
So this is, today's the first time I heard Nick's line that the media's job is to make every problem your problem. I like that. I'm going to steal it from him. But this is certainly one of the things that you hear about is, taxes are so high and, it's a feeling. No one likes paying taxes, but the reality is we are in a very low tax environment. Even through the last 3 presidencies, they really haven't moved drastically. Now the top line between Obama, Trump, now Biden, they've increased marginally. Like the top rate went from 37 to 39.6, but it's still very low if you compare it to historic terms. So a lot of times with clients that have after-tax accounts, there's investments that offer tax-free interest, right? It's very intriguing, and everybody just is wired to say, I don't want to pay taxes, so I should invest into that particular investment because I don't have to pay any income tax, whether it's at the federal level or also the federal and state. What we look at is what we call the tax equivalent yield, meaning a tax-free investment is going to pay you a lower amount of interest than something that's taxable. And if you're in a low tax bracket, oftentimes, majority of the time, you're better off taking that higher amount of income, paying the taxes. Your net amount after the taxes is still higher than what that tax-free investment would be. So, it's not until you get up, in closer to like the 30+% tax brackets where some of those, tax-free investments may make sense. But again, that's something that you'll talk with your advisor about your portfolio. The narrative here is, we're still in a pretty low tax environment. Our expectation is rates will probably go up over time, but it's likely not going to affect most retirees. If rates go up for retirees, it's going to be very marginal. If you look at a lot of the proposed legislation and things that they're trying to do, it's really targeting people at the high end of the income stream, right? So 400,000+ to $1 million+. That's really where a lot of the proposed legislation is. It's not everyday people or retirees that are going to be, feeling that burden of tax increase.
And I think it brings up 2 points. One, as Roz said, we need to look at your situation. Is tax-free better than taxable? Everybody's different. The other thing to look at when we look at planning, it's not just today or tomorrow, it's across generations. So as Dan alluded to with some of the Roth, perhaps it makes sense for a parent who may be in a lower tax bracket to convert things to something that'll be tax-free when it's inherited. If your kids are in a higher tax bracket, maybe you pay the tax at 13-14%, whereas they'd be higher down the road. So these are conversations to have with your advisor because everybody's situation is absolutely different. But it's very easy to fall into some of these things where you think, some things makes a lot of sense just because you're hearing about it. Are there any other questions? Actually, someone just asked that if we expect taxes to increase, is it wise to convert to a Roth now? In many cases it is. But again, we have to look at the circumstances. Because the other thing is, if you convert to Roth, you do have to pay tax today. It could affect your Medicare premiums. It could affect your Social Security. There are other considerations. So it's not a set answer for everybody. We need to do the calculation. Any other questions for us? There's two more just popped in. So, what do you think the war in the Middle East and the Ukraine are on the outlook for the markets? What I will tell you is, from an economic standpoint, wars are very good for the market. I'm not saying wars are good. I'm not making a judgment. But if you think about it, every time the country has been in a downturn and we've had a war, going back to World War II, the markets have taken off. That's because it costs a lot to do this. Specifically, for example, with Israel, you hear of us supplying for the Iron Dome. Have you guys heard about the Iron Dome? Well, we just sent them a whole lot of reloads. Those are $60,000 each. An American company called Raytheon makes them. So all these types of things create dollars for the U.S. markets. And why war is awful. From an economic standpoint, it's probably a good thing to generate revenue. So do we have any other questions for the panel? Yes. No, that's a great question. Question is when the exclusion expires, you lose portability. And what Ron's referring to, it used to be if one spouse passed away, their estate credit got lost unless you did some planning. They changed that so that if you don't use your estate credit, it automatically goes to the spouse. That will not go away. At least it's not written in it to go away. Any other questions? As always, our entire team is available. That's why we have so many of us. And even tonight, Gail, back there, all of us will be around. Feel free to reach out to your advisor. I also encourage you to check, the website or all the stuff we send you. We do have a couple events coming up in January, our annual resource event, and then in February, something really interesting. A guy named Chris DeSantis, he wrote a book called Why I Find You Irritating. Intergenerational friction at work. And it's why different generations think differently and why, for example, if you deal with a millennial, why they act the way they do, or why you'll see two people sitting at a restaurant table texting each other instead of talking. You'll learn why they do that. So you've got that coming up and a bunch of other stuff. And then as always, as events happen, we do put out information pretty much every other week. There's a little video and then some blogs. You can access all of that at any time. And of course, if you have friends or family that have questions, we're always happy to talk to them without, cost or obligation. So with that, we do appreciate you guys coming out and hope you have a good evening.